Ladies and gentlemen, and welcome to today's Knowledge Group webcast, Valuation and Accounting for Venture Capital and Private Equity Funds, a Practical Guide. I'm Sanchi Ingrasso, your moderator for today's event, and we're going to hand over to our speakers in a moment. However, I would like to point out that over the next few slides, you'll see information about the mechanics of our event, information about our participants and their firm. For those viewing via PC or Mac, you can maximize the presentation by clicking the Launch Full Experience button found at the bottom of the webcast portal. After clicking, you'll also see the event's chat window on the right of your screen, where you can see our speakers' contact information, answers to frequently asked questions, and you can use the Q&A tab to type a question to our speakers. The questions won't appear, but we will collect them and address as many as we can in the Q&A session towards the end of the event. You'll also see a link to sign up to a 14-day free trial to access some of our live and recorded events. Please note, if you click Launch Full Experience, you may need to close the original browser window to prevent duplication of the audio that may occur. Should you encounter any technical issues, please refresh the event page, and if they continue, refer to the information in today's reminder email. For any other questions, contact us via email at info@theknowledgegroup.org or via the live chat on our website. You can view certificates you've earned, your continuing education requirements, and more via your account page on our website or on the go using the Knowledge Group app, available on iOS and Android. And on that note, if your firm is looking for a new way to reach customers and help them manage their appointments, a custom low-cost app from Apps for Law Firms can help. Email info@appsforlawfirms.net or visit the website for more information. That's appsforlawfirms.net. Finally, everyone will be sent a survey via email after the event, and if you're applying for continuing education credit today, this is mandatory as proof of attendance. 4 secret words will be read out at randomly selected times, so attendees, please make a note of these secret words as you'll need to enter them into the survey to get your credit. Now, before we begin, I would like to take a moment to thank our partner firm, Withum. Their information is on screen right now, and thanks to our speakers for their time, help, and support preparing for this event. And of course, thanks to all the attendees joining us today. Now, on today's webcast, we have the following speakers: Thomas Angell, CPA, partner and financial service practice leader at Withum. Tom Angell is the practice leader of Withum's Financial Services Group based out of the firm's New York office. With over 30 years of experience specializing in private equity and venture capital funds, he services a diverse client base, including credit funds, hedge funds, fund of funds, investment advisors, and regulated funds. Joining him on the panel today, Michelle C. Keys, Senior Manager at Withum. A senior manager in Withum's valuation and financial services audit practices with over 15 years of experience in performing and reviewing valuations. She has provided valuation services and performed valuation review procedures for public and privately held equity, debt instruments, and derivatives across a variety of industries. And now we're going to begin our event. So speakers, to advance your slides, remember to just say next slide at the end of each page of your presentation. If you want to go back and review a previous slide or maybe jump ahead to a slide, just give us the slide number and our tech will take you there. So now I'm turning everyone's attention to slide number 9. And to our speakers, Tom and Michelle, it's over to you.
Thank you, Sal. Appreciate that. Welcome, everybody. Good afternoon. This is Tom Angell, and as Sal said, I'm the practice leader for the financial service practice at Withum. And to kind of kick it off, before we get into the program, we know the guide's been out there for almost a year, and I'm sure you've attended a number of webinars or conferences talking about the guide. But we thought it was a good time to have another conversation regarding what we've been seeing in the marketplace in terms of valuations that we're seeing produced by venture capital funds and private equity funds, as well as the fact that the COVID-19 pandemic has obviously affected markets. And we thought towards the end of that, we would discuss valuations during that point. So, Sal, if you could move the slide to the next slide, please. So I'll start off, Michelle, what does the AICPA task force consider to be the main purpose of the guide?
Thanks, Tom. The task force main objectives and main purpose of putting the guide together is to put forth and identify certain requirements under financial reporting standard ASC 820 and provide best practices guidance for financial reporting issues that are specific to investment funds and venture capital funds that aren't necessarily directly addressed by FASB under ASC 820. The guide was developed specifically for investment funds and venture capital fund managers, auditors, and also for valuation specialists. And it addresses a variety of investment types across different stages of investment and related life cycles of portfolio companies. Next slide, please.
So, based on that, Michelle, is this guide just, even though it was produced by the AICPA, is it just based for auditors? Is it based for a different group?
No, it's geared for different groups, namely reporting entities or funds, valuation specialists, and auditors. And it's actually very pragmatic in its approach because it actually provides case studies and examples of different types of valuation methodologies and takes the user through life cycles of investments from seed stage all the way through an IPO or an M&A exit. And throughout these case studies and examples, the guide gives the perspective from basically the fund's reporting perspective, valuation specialist review perspective, and auditor reconciliation with accounting guidance. So it really is a really valuable tool for all of these entities. Next slide, please.
So we'll talk about some concepts of fair value, which are good to revert back to when we talk later about valuation during COVID-19 and the markets that are being affected by that at this point. We won't cover every single chapter, but we will cover some that have relevant concepts to what we want to go over, and to also, as a backdrop, discuss some of the things we've seen in the marketplace and what's being done, and what we think should be changed by whether it's the private equity or venture capital funds in terms of putting their valuation policies together. So the fair value definition, basically, as it's defined in 820, and obviously 157 was before that, and also IFRS 13 covers it, is that it's a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. And a key example or key item here is that cost does not equal fair value, but fair value may equal cost. So we see out in the market where some investment companies anticipate keeping their value at cost for a period of time, and that may be fair value, but there are things that they need to do to work through that. So Michelle, if an investment isn't recent, what's the task force emphasize regarding valuations of transactions which were further back?
If a transaction isn't recent, what the guide basically directs preparers of financial statements and reviewers of financial statements to do is to use a concept called calibration initially, which is the concept that we'll go over a little later on in our presentation. But for now, what I can define it as is looking at what the expectations were for the investment and what the rationale was for the fund to have made that investment at the original investment date. Take into consideration what the expectations were at that point in time relative to milestones that were expected to be met, growth rates, maybe potential profitability that was expected to be met. And then at the current valuation date, comparing where that portfolio company or where that investment is at that subsequent date compared to what the original expectations were, and updating the valuation accordingly. And in some cases, especially for early stage, very early stage investments, there might be more of an emphasis on qualitative rationale and qualitative explanations for change in value. But just going back and echoing what Tom said, if cost doesn't always equal fair value, but fair value can equal cost, and entities just need to support through their documentation and analysis why the current fair value indication should equal cost.
Yeah, and sometimes there's questions, we've gotten questions, especially by new funds that are setting up. Why do we need to do fair value? Why is it required? And there's a number of reasons why we got to this point. Obviously, private equity and venture capital closed-end funds. So, in theory, whether they fair value at a point in time or once they liquidate the positions, they're going to end up with the dollars that they're going to end up with. But what this takes into account is a lot of the LPs, institutional LPs, make their asset allocations to funds and public securities and other investments based upon their own individual asset allocation formula. So they need to know on a more current basis what the values are with all their investments, similar to what they could get in the public markets. So that's one important item. The other is they need to report to their ultimate investors. So if you have a pension fund that needs to report to its board or its ultimate pension receivers, they need to know on a more regular basis what the fair value of those investments are. So that's how this all came about, among several other reasons, but those are some of the important ones as to why we do this and go through the process. Next slide, please. So Chapter 3 talks about market participant assumptions, and again, this will be important when we kind of get towards the end of the presentation on the COVID-19 issues. But what the assumptions are that the buyers and the sellers in the principal market for the asset or liability, they have the following characteristics. So they're independent. If they're not, obviously, then you don't have an arm's length transaction, so it's hard to discern whether the value is fair or not. They understand the asset or liability that they're transacting on. They can enter into transactions. In other words, they have the ability to either buy it or sell it. And also for our discussion today, the participants are willing to transact in the particular investment at the reporting date. So that's the main assumptions and the 4 key assumptions that you need to have in order to ascertain that a transaction is fair value. And Michelle, anything you want to add to that?
Yeah, thanks, Tom. It's also important to think about the concept of market participant assumptions. Keep that concept in mind when you're performing your valuations and you're trying to select what you think are the most reasonable inputs and key assumptions that go into the valuation process. Market participant assumptions are meant to reflect, in the actual valuation analysis, they're meant to reflect key performance indicators of a portfolio company, for example, and also key market indicators that an investor would consider when he or she is estimating what price they'd be willing to pay for a given investment at your particular valuation date. And always keep in mind, too, that GAAP, under the standard of fair value, requires that the reporting entity assume a hypothetical sale of the subject asset or transfer of a liability at that particular valuation date. So always keep in mind, what information would actually be available or be made available to a potential buyer, and what information would be pulled together by a particular seller or individual seller in negotiating that price. Next slide, please.
Michelle, you want to cover this?
Sure. Thank you. I just got the next slide on my screen. Sorry about that.
Okay, no problem.
So the chapter 5 of the guide goes into a lot of detail on some pretty fundamental valuation concepts, which I'm sure a lot of the people in the audience are familiar with by this point, but we wanted to highlight them anyway, just to re-emphasize them and put them in the context under which we're speaking of today. So the guide addresses criteria and selection of the different valuation methodologies at both the portfolio company level when you're valuing the total equity of a portfolio company, and then also the guide gives a tremendous amount of information and directives around valuations at the level of unit of account of a particular investment. So whether it's a particular series of preferred in the capital structure or it's a bridge loan, the guide contains really, really valuable insights and frameworks and case studies around the methodologies. So I'll just quickly go through each one of these. These are the main valuation methodologies that are used for fair value reporting for all different types of valuation purposes. The first one is the market approach. And within that approach, there are a couple of different methods. There's the guideline companies method. There's a similar transaction or guideline transaction method. You can look to transactions in the subject security that have gone on in the marketplace for pricing information and benchmarks. The second valuation methodology that's very frequently used and accepted in fair value reporting is the income approach. And under that approach, you'll often see used discounted cash flow method, discount rate adjustment technique method, and an expected present value technique. And these, again, are all, there are examples of these in the guide throughout the different case studies, and the guides give you indications of when it's appropriate to use each one. And then you also have the asset approach, or sometimes that's also called the cost approach. You see that approach used in more specific situations. And I think, Tom, you might want to, I know you have a lot of experience with this approach, and I thought you might want to chime in here.
Yeah, so typically the asset approach is used more in early stage development companies, like a tech company or maybe a real estate development project, where it may be more cost expenditures. So if you got a real estate project that you're looking at, it's a $100 million project, and right now you've got $5 million in the ground. It's more the assets that you have in terms of, what it costs you for the land and what it costs you to put things together in terms of the construction to that point. So that's a place where it'd be more likely than not that you would use that approach, or a technology company where you're building out intangibles, and so there's a cost associated, maybe building out a software development, things like that. That is probably more where that becomes of use. From an audit perspective, if you don't use any one of these valuation methodologies, then you need to document why they weren't chosen and why you went with a different one. So it's not, there are others you can use, but you have to document why your particular valuation methodology was better than the ones that were placed in the guide. The other thing that typically may happen, especially on private equity funds and maybe some more senior venture capital funds, is they may use multiple valuations and multiple methods, and take some percentage of each one of those methods. And it's not that they're trying to prove each other out that they work. They just want to corroborate that the methodologies seem to be similar. If one of the methodologies is way offline, then you really need to revisit why that one particular valuation is so different from the others you've taken a look at, and maybe take a look at the inputs and what you've done. So those are some of the pieces that we see out in the marketplace and that we see some of our clients using. Next slide.
And before we do that, let's do our first of the 4 secret words, which is fund. F-U-N-D, fund, secret word number 1. So if you're an attendee seeking continuing education credit, a bit of advice. Jot down fund as the first secret word. This way you'll have it for the survey we're sending you. You need all 4 in the survey to get your credit. So remember, fund is secret word number 1. And now it's back to you, Tom and Michelle.
All right.
Thank you.
All right. So the next thing we'll talk about, which is covered in Chapter 8, begins at 8.14, is some of the criteria for selecting a valuation methodology. So some of the things you may look at is the company's stage and nature of its operations. Another item may be the expected time until an exit or a liquidity event, and potentially how many more financing rounds they may need to get there. And then also the economic or control-based rights with particular shares of the investment, and whether those rights are aligned with the class of shares, which controls the timing of the portfolio company's sale or liquidating event. So, Michelle, based on this, is it reasonable to assume that as a particular investment goes through development milestones, that potentially the valuation methodology may change?
It's definitely reasonable to assume that. You can think of it along the lines of, a very early stage, a seed stage investment where there might not be, or there isn't, a lot of quantitative information available at that point in time to perform certain valuation using a certain methodology. But as time goes by and the investment meets different milestones, and there's more information made available in terms of metrics and performance indicators, you might switch, for example, from using that asset or cost approach that you mentioned earlier, Tom, to an income approach, because you have more reliable information on what the expectations are for the performance of the investment over the next few years, or even up through an exit. And you can also think about the valuation in terms of, for very early stage investments, value at each milestone, and associated probabilities at those points of being successful in reaching the next milestone, and being successful in being able to achieve another financing round. Or, if unfortunately the investment's not doing well, the downside scenario where maybe the probability is higher that the next milestone won't be reached. There won't be another financing round, but there still might be some value in some of the intellectual property that can be estimated. So it's definitely reasonable to assume that the valuation methodologies might change over the life cycle of an investment. And it's also very important for reporting entities and teams to document if you are going to change your valuation methodology from reporting period to reporting period. It's really important to document the rationale as to why your valuation methodology has changed, and why a market participant would consider your new valuation methodology a reasonable approach to figuring out fair value at the new valuation date. Next slide.
Before we jump onto that, we can go to the next slide. There's just a question for you, Michelle. We talk about projecting out future cash flow needs in order to do an exit. And you can work through that, on a cash flow basis. But those future rounds, how do you look at those in terms of from a value perspective? So last round, let's say we raised at $2 and you know you need a few more rounds maybe to get to your ultimate exit. From a valuation perspective, how do you look at those additional rounds?
The guide has some really good examples of this, and basically what it illustrates is trying to, and it's not going to be, it's going to be within a range of reasonableness based on what could reasonably be known at your valuation date and the business plan going forward, but trying to determine what the total capital needed will be to get to that exit, and the timing of those capital rounds, and trying to come up with some kind of reasonable assumption for the price per share and the number of shares that might be in the capital structure at the point of an exit. And the guide takes you through certain examples of that, and it also provides some indications of how to consider the impact of potential dilution as a result of future financing rounds as well.
Okay, thanks. Chapter 8 is the next thing we'll talk through. We skipped a couple of chapters because they were more on simple structures, so kind of jumped ahead to complex capital structures. So they have various methods that they talk about in this chapter. One is the scenario-based method, which has the simplified scenario or relative value scenario, or full scenario analysis, which is also known as PWORM, and it was brought about the probability weighted expected return method, and that was brought into play in the guide several years ago about valuing stock-based options for a company. And the current value method, which is also known as the waterfall method. So, liquidity event by acquisition or dissolution, and then equity being valued as seniority over other classes of equity. The OPM model, which is senior and junior preferred classes of equity, and there's limitations on the OPM. And then there's a hybrid method, which is a it's a hybrid of the scenario-based methods and OPM. So, it would seem, Michelle, that if we just did the waterfall calculation, why wouldn't that be considered reasonable for all investments?
Well, under certain scenarios, it is considered reasonable, and one of the scenarios where it is considered reasonable is if the interest that you're valuing, one of the equity class that you're valuing, can effectuate a sale or a liquidity event of the portfolio company at around the valuation date. That the guide basically indicates that the current value or / waterfall method is appropriate in that type of a scenario, because the interest that you're valuing actually have the ability to effectuate a sale at the valuation date. If the equity positions or interests that you're valuing are not part of the controlling share class of equity in the capital structure, and you're a minority position and you cannot effectuate a sale, then best practices indicates that there's probably some kind of time factor involved in you having to wait until you can monetize your investment, and that time factor should be factored into the fair value indication that you estimate for your particular class of equity.
And we'll go through some examples of some of these later on in the slides. Could we jump to the next slide, please? So the next slide we talk about is calibration, which is in chapter 10, and it's a pretty long chapter with a lot of different types of examples. So it's a good thing to kind of flip through. We talk about it's the input assumptions to an observed transaction. So that's what calibration is. And then really what you need to do is over time, you would update your calibrated inputs at different measurement dates. And we have some questions here, which we will cover kind of later in the slides, but when is a transaction a reliable indication of fair value? And then, later on we'll cover how to apply calibration in valuing a debt or equity investment, whether you use the income approach or market approach, and also inferring value from other transactions in the portfolio companies, other instruments. And then also consideration of valuations performed for the portfolio company. So it could be under 409A or a tax valuation. So there's different other things to kind of look at to deal with the calibration issue. Michelle, anything you want to add?
Thanks, Tom. I think it's important to emphasize the fact that calibration is actually required by GAAP. So this is, there's guidance in the guide that is not necessarily considered authoritative, but it is considered best practices. But this chapter on calibration and the concept of calibration, it's important for everyone to remember that this process, it's required by GAAP in the estimation of fair value for financial reporting purposes. So basically, just to echo a little bit of what Tom said, calibration is used to assess the inputs or the key assumptions that go into a valuation analysis. And what you would typically do would be to look at the entry price that was paid or the last valuation that everyone signed off on as being reasonable, depending on the amount of time that's gone by since your original investment. But basically, you're reconciling back to a transaction or a prior fair value indication, and you're looking at the inputs and the assumptions that went into that valuation, and as long as that valuation could be considered to be reflective of fair value. And the guide actually does give a lot of criteria and explanation as to when a transaction can be considered to be reflective of fair value and when it shouldn't. And then once you reconcile and you have that information from the original investment or the prior fair value indication, then at this new valuation date, you're selecting new assumptions and key inputs that would be updated from those prior inputs to reflect company-specific progress that's been made and also what's gone on in the market in terms of pricing for similar assets. So you're basically trending the valuation from one reporting date or investment point to your current valuation date, and you're taking into consideration what's gone on at the company and what's gone on in the market and how do my original inputs change over that period of time. Next slide, please. Oh, sorry, we are on the next. Are we? Sorry.
Yeah, no, we need to go to the need to go to the next one. Yeah, but before we jump to the next slide, so just they have a good example in the guide to just cover what Michelle discussed. So if you look at an investment and you decide to pay 10 times trailing 12-month EBITDA, and because you think that there's some things you can do to enhance value and bring it up, and you have some high anticipations for revenue growth, and then you do your calibration and you look at public comps, and the public comps average out to 8 times. So you're paying more for your private company than what the public comps are. And like I said, you have good reason why you think it can get to that point. So that becomes your calibration point. You're 10 times versus 8. And next time you go around, let's say a year later, you're doing your valuations and you go look at the public comps. Now, if the public comps are up to 9, then you should, based upon that calibration and all things being equal and the operations of the portfolio company you purchased and those operations are going according to plan, your 10 times in theory should be worth a little bit more than that because the public comps went up. So there's a number of examples, but that's just one of them, just to kind of talk through how you look at calibration and how you look at it over time. Next slide. Next slide talks about Chapter 11, and it's back testing. And so the task force and the guide itself said that it's a best practice to do back testing. And so basically you would take a look at, a transaction that occurred at some point in time and relate that back to how you were doing your valuations. It's not a right or wrong, but it's to help you enhance the valuation process on a go-forward basis to maybe see what particular items you might not have taken into account. Sometimes transactions happen for a different reason, and you might not even understand why they're higher or lower than what you were pricing. For instance, a synergetic company may buy the portfolio company and be willing to pay more because there's a lot of costs that they can cut out. So it's hard to know, but it's a good thing to do to kind of take a look back and try and ascertain how your valuation process is and if there were tweaks and things you can make to improve it as on a go-forward basis. Anything to add there, Michelle?
You did an excellent job. But basically, you're really just testing the reliability and validity of the valuation methodologies that you've chosen and the assumptions that you've made. And it's just a good sanity check on the back testing is a good sanity check on those two things, on the methodologies, and maybe even some of the weightings that you might be putting on different methodologies, as Tom spoke to earlier. Next slide, please.
And before we get to that next slide, let's do the second secret word, cash. C-A-S-H, cash, secret word number 2. Jot it down, get your credit. Secret word number 2 is cash. Tom and Michelle, back to you.
Thank you, Sal. All right, so the next slide, we're talking about some of the common valuation issues that are addressed in the case studies that they lay out. And Michelle, from your point of view, how practical is the guide for individuals that may not have a deep accounting or valuation knowledge?
My point of view, I don't think, having gone through the guide over the last year and a half and gone through all the case studies and actually used the guide in the last busy season as part of our review function at our firm, I actually don't think that you need to have a very deep accounting background or a very deep valuation background in order to understand the rationales that the guide selects for different valuation methodologies for different investments at different points in the investment cycle. And there's a lot of really pragmatic and easy to understand explanation as to how certain assumptions can be supported in valuation across different types of investments, and also, again, across different stages of the investment cycle. So I think that actually, if I didn't have a deep valuation background, let's say, for example, I think if I were to look at the guide, I think one of the first places in the guide I would look are the frequently asked questions section. And I would also just take a look at some of the case studies that involve the types of investments that I most frequently are involved with. So there are different examples and illustrative calculations for different equity valuations, and it's also industry specific at times. There are case studies that relate to real estate investment funds. There's an energy case for oil and gas and biotech. So I think that because the guide is so large, and contains so much, it can seem intimidating. But I do think that it's really meant to be very user-friendly in the way that it lays out the case studies, and then those case studies will reconcile certain key aspects of the valuation back to the chapters, where you can get even more of a detailed explanation as to why a certain methodology is being selected, or how the final fair value indication is ultimately supported. So that's actually, I guess, more of a long-winded way of saying, no, I don't think you need a very deep accounting background or a very deep valuation background to really benefit from the guide.
Yeah, and I think another thing with the guide is they have so many different examples and industry-specific examples, but it's really good for the auditors out there to help their clients along. If there's a situation where they may have a question, you can point them to some of the examples in the guide to help them understand some of the valuation methodologies that are out there if they're not totally up to speed on a lot of the valuations. They can do the deals and get comfortable with the analysis they do internally, but then to put valuations together and policies together, the guide's very helpful to cover a lot of specific valuation issues that may come up, whether it's a venture capital or a private equity fund, whether it's on a equity basis or a debt basis. So it's very helpful in that case. Next slide, please. So chapter 14, as Michelle said, is very helpful in terms of having a lot of frequently asked questions and helping you understand and walk through some of the issues. So we have a question here, which is a frequently asked question in the guide. So is there a rule of thumb for a time frame during which it is permissible to carry our investment at cost from the date of initial investment? In other words, like taking a 1-year safe harbor? And the answer is no. The value may not change significantly in that period of time. Other cases it may. So you need to really do some kind of workup to try and reflect what the exit price would be at the measurement date, typically at the end of the year, when we're taking a look at it from an audit perspective. We'll talk to venture capital funds that are launching, and we'll sit in a meeting with them, and they'll say, well, our policy is going to be that we're just going to keep it at cost for the first 2 years unless there's a transaction, which obviously isn't GAAP. And so we need to kind of educate them and walk them through that and help them understand the process that they need to go through in order to get to fair value at the measurement date. Michelle, anything else to add?
Yeah, I would add that it's important to remember that the valuation at your particular valuation date is based on what could reasonably be known about the performance of that investment and what's going on in the marketplace at your valuation date. So while you and the deal team might have had a certain set of expectations last year when you initially made your investment, the keeping it at cost. Remember what we said earlier in the presentation about cost not equaling fair value, but fair value could possibly equal what you paid in the prior year. Need to, as Tom said, document even if there's not enough quantitative information yet, because your investment is so early stage, some kind of qualitative explanation as to why the original investment and price that you paid last year would still be considered a price that a new market participant would come in and pay this year. And remember what we said earlier also in the presentation is that GAAP requires a hypothetical sale of the asset or a hypothetical transfer of the liability. So you're always looking at things from the perspective of what would you be willing to sell your investment for to somebody else this year, and what would they be willing to pay for it based on what they know this year and what information you have available about the investment.
Next slide. So this slide kind of reinforces what we just kind of discussed, only coming up from a different angle. So it's not generating revenue yet, but can I leave it at cost until the next round is going to price? And obviously what we discussed before was that's not really GAAP and not really how it should be handled. You know, there's calibration that you could use to assess the inputs, and just, you know, you're consistent with the entry price. So you have milestones you're going to look at on a go-forward basis. You know, as Michelle said, there might be qualitative inputs instead of quantitative. So those milestones will be looked at, and you would update in order to try and get to a fair value at the measurement date. Anything to add there, Michelle?
I think the next slide actually kind of gives more detail, Tom, into
Sure, okay.
And folks, before we get to that, let's do the third secret word, which is value. V-A-L-U-E, value is secret word number 3. So now, attendees, you have 3 of the 4 secret words which you're going to need for the survey to get your credit, value being the third secret word. And not to interrupt again, let's go back to Tom and Michelle.
Thank you.
Thanks. So Michelle, since you like this slide, why don't you go ahead and jump?
Sure. So just to expand a little bit more on what we spoke about in the prior slide, where you remember that frequently asked question when somebody brought up the issue that they had was, hey, my portfolio company, my investment's not generating any revenue yet. How am I supposed to figure out what fair value is this year? Can I just leave it at the value that I had last year, or at the price I paid originally? So what the guide actually gives a couple of examples in a situation like this, and I tried to summarize things more qualitatively here for sake of time. But it involves that concept of calibration, as Tom mentioned, and what the guide says is best practices in a situation like this is to kind of roll forward the value that you obtained in a previous financing round, where you were comfortable that was like an arm's length deal, or that value is actually, you know, at fair value at that point in time. You're taking that value indication, and you're moving it and trending it forward using calibration. So you're asking yourself, or your analyst is asking himself or herself questions around, you know, how has the entity performed relative to what was expected at that prior investment date or that prior fair value reporting period. Is it on plan? Has it met the milestone, or is it on plan to reach the milestone that was expected at the last financing round? Has there been any kind of value creating events that have occurred since the last financing round or the last valuation? Whether it's some kind of quantitative event like a new round, or some kind of qualitative event where the company got a new customer, or you got a new patent that's not, you know, generating any revenue yet or any licensing revenue, but it's obviously very valuable. And, you know, how much cash runway do we have at our current valuation date, and what are our prospects for raising another round of financing? And in these kinds of situations, and you'll see when you look in the guide, there are a lot of reliance upon scenario analysis, where there'll be, you know, an upside case and a downside case, mostly for the really early stage situations where if you're not going to get the next round of financing, unfortunately, you're probably not going to, the investment's probably not going to yield much at all. Or might be a situation where there's a high, a mid, and a low scenario analysis that are probability weighted to come up with a finer fair value indication. So I think that it's definitely challenging to come up with a fair value estimate for an investment that's not generating any cash flow yet. But the guide actually lays out a framework on how to do that and what criteria to consider. And if you are relying more on qualitative factors to support your keeping your value indication at the prior indication from the prior reporting period or from cost, again, the emphasis on being able to explain that, document it, and really explain it from the perspective of why somebody would still be willing to pay that original cost basis or that prior fair value indication today at your current valuation date.
And now you see all the work that has to go into, early stage companies. We can understand why the funds we talk to just want to keep it at cost till something happens.
Yeah, that's right.
All right, next slide. So one of the other frequently asked questions that we're going to cover here is how should the valuation capture the fair value of senior and junior classes of equity? And the guide, they talk about, at very early stages, the outcomes could be, they say in the guide, bimodal, where it's either a big success or a failure. So if it's a failure, nobody gets their money back, everybody loses. If it's a big success, then all the classes will wind up getting money, and so sometimes the participation rights may not matter as much. So there's a few things that they'll discuss and give some other examples of in the frequently asked questions to kind of cover that. And we kind of talked about this earlier. Michelle, you want to add on to that?
Sure. I think one of the things that the guide emphasizes throughout the case studies and the examples is that valuing your particular class of equity on a fully diluted post-money valuation, everybody converts, isn't always necessarily considered appropriate, and it depends upon the facts and circumstances of what's going on at the portfolio company and I guess maybe to a lesser extent in the marketplace. But when it comes to IPOs, obviously we've seen, especially over the last, prior to the pandemic hitting, this was happening even then, where certain companies were expected to IPO, but they decided to postpone their exit through an IPO just because of how they saw other companies faring once they went public. But just to circle back to what my main point, I think that what the guide's trying to say through its examples is, valuing all classes of equity at the same per share price, regardless of any kind of thought or explanation as to why that makes sense, it is not considered best practices. So in certain instances, as Tom mentioned, it does make sense where the company is really close to an exit relative to your valuation date, and there's enough value in the total equity of the company at that point in time to where all classes of equity have their liquidation purposes met, and depending on whether there's accrued dividends, there's enough value for that, and there's enough value allocated down to maybe the company has done well, but it hasn't done as well as expected. So that there's definite incremental value being generated as the company progresses, but there's just not enough value in the total equity at your valuation date to be able to support all the shares in the capital structure being valued at the same exact price per share. So maybe in that kind of instance, there's certain classes of preferred that have more advantageous economic and control rights that would warrant a market participant being willing to pay more for that class, let's say Series A, versus what Series B might be worth per share on the same day, just because there's not enough value yet in the total equity of the company to warrant those two preferred classes to be priced at the same price. So again, you know, it's a case by case basis as to whether or not, you know, a post-money fully diluted valuation makes sense at a particular valuation date. I think that's the key point that the guide is trying to drive home to everybody.
Next slide. And this next slide kind of reinforces what Michelle just said. It's an example that they given the frequently asked questions. I'll just go through it real quick. So we just completed a Series C financing for one of the companies, and the pre-money was 80 million with 16 million shares outstanding. And we raised 20 million for 4 million shares at $5 a share. So if I'm using the post money at 100 million for the valuation, how do I allocate that between Series A and B? And as Michelle just discussed, you know, it depends on whether or not there are preferences in share B or potentially maybe in share A in terms of determining when a liquidating event can happen. So if all shares are basically equal, or as Michelle said, there's enough money to cover all the shares and the different preferences in there, then yeah, you could use the same valuation for those shares. If not, then you might have to apply an allocation method that gives the differences between those shares. Next slide. Michelle, this kind of builds up on the other two slides that we were talking about. Maybe you want to cover this one? And
sure. I think we're definitely re-emphasizing the same points. And I think what we wanted to convey in this slide is that it's not just it's not just an all or nothing. Everybody converts at the same price, or, you know, we can't figure out what the valuation is for the different, or we shouldn't be trying to figure out what the fair value is for the different classes of preferred. Even if the investment, the original expectation was, hey, we're going to have an IPO, and the IPO will be, you know, 5 years from now, and that's, you know, that's our goal. And, you know, over time, goals get revisited, and business strategies change, and even markets change in terms of willingness to have an IPO versus maybe a private sale. So I think what in this slide, what we're really trying to convey is that, you know, as time passes and the capital structure of the company gets more complex, that when you're trying to estimate the fair value for your particular class of equity, you really need to consider and read through what the rights and some of the restrictions are and the differences are between the different classes of equity before you decide how to allocate or come upon a final allocation of that total equity value of the company.
Next slide. So the next slide is kind of further emphasis on the rights of a particular shareholder or class of shares, and what methods would make sense to utilize if they can control the liquidating event. And Michelle, it kind of tied into what you've been talking about, but maybe you can go into a little more detail on this.
Sure. You might recall we mentioned this a little earlier in the presentation. It's a method of allocating that total equity value of your portfolio company. Once you come up with the fair value of the total equity, then obviously you need to allocate that down through the various classes of equity that are in your company's capital structure. And this current value / waterfall method, I think it's pretty common. I think most people who review valuations or perform valuations in private equity and venture capital have seen this approach. And what we wanted to highlight here, and we touched upon earlier in the presentation, is that the guide, in terms of defining best practices, it indicates that this method of total equity allocation across the capital structure, it's considered reasonable and best practices in certain situations, but not all. So, for example, one of the situations where it is considered a reasonable way to allocate the total equity value of a portfolio company across the capital structure is if your particular investment is part of an equity class that can control the decision to effectuate a liquidity event like a sale or an IPO. In that case, what the guide is saying is that you can actually, because you actually have that ability, you could actually determine what the fair value is and how to allocate the total equity value at your valuation date, assuming a sale could be effectuated at that valuation date, and that you're not a minority equity holder who would have to wait from your valuation date for another 2 to 3 years before the controlling class of shares and the board of directors decides, hey, it's time for everybody to get monetized and exit. So in the case where the guide is saying it's okay to use this current value or this waterfall method, on the upside is when there's a sale and your class can effectuate that sale. But what's important also to note here is that what the guide is saying is you can do that and you can use this methodology, but it's probably going to give you, in a lot of cases, like a lower bound on fair value, because by using this approach and assuming there's a sale at the valuation date, maybe you're not projecting out for another year or two what the actual growth will be in your company, and you might be it's a reasonable value that you might get through the current value method, but it might be a lower bound on a range of reasonableness, because this is not forward looking, right? This is a methodology of equity allocation where you're saying we're selling the company at December 31st, 2019, which is our financial reporting date. That's our assumption, because we can make that assumption because we're Class A and we decide when the company is going to be sold, and we're going to take this approach. And you're using the revenue and maybe the profits as of December 31st, but you're not including any kind of forward-looking performance for the company that you could reasonably support at December 31st, 2019. So by doing that, you're kind of capturing the lower bound on a reasonable valuation using this current value method. There are other methods, which we'll speak to shortly, of total equity allocation that capture the forward-looking component of evaluation and equity allocation.
Next slide. So this is just kind of proposing the question that Michelle just discussed in terms of what other methods we can use. By the way, the discussion we just had regarding someone that can control a sale or liquidation at the measurement date, we don't see that put in practice a lot, but it is out there and it is something that's discussed in the guide. Why don't we go to slide 21? I'm sorry, not 21. That's just next slide, 29, I guess it is. So here we're going to talk about criteria for selection of valuation methodology. So we talked about some of these things earlier in the program. Again, it's all covered in Chapter 8. And so one of the things which we've mentioned a few times is understanding the control and economic rights of each share class. And that's important to decide what allocation methodology and valuation methodology is reasonable under certain criteria. So if there's different seniorities, you might have to take a look at who controls the decision about the timing and when. Typically, newer investors coming in may have higher liquidation preferences and may have more negotiated rights. Those need to be taken into account as well, and when you're looking at liquidation preferences and other things. They may be valuable and they may not, depending on the situation. So it's important to look at those pieces of the entity itself. Michelle, anything else to add?
No, I actually think that you covered it all.
All right. Go to the next slide, please. So here we're talking, and we kind of discussed this before, typical liquidation strategies. And Michelle, maybe you can go into some detail on some of the methodology we'd use under some of these strategies.
So in deciding what methodology to use to allocate the total equity, in addition to considering the control and economic rights of the different series of preferreds, and relative to what you own, you would also consider, when you're trying to decide on what kind of a methodology to use to allocate total equity across the capital structure. As we mentioned earlier, you'll be thinking about what is the next, what's my exit strategy? And if it's not an exit strategy yet, because I'm so early on in terms of the life of this investment, because it's an early stage investment, what's the time to the next milestone that we expect to reach? And why this is important is it relates to what we explained before, where if your portfolio company is at a point where you know it's going to exit relatively shortly relative to the valuation date, and it's at a value, the total equity is at such a high value where everybody would be basically exiting at the same price, then you're going to use a more simplified or a simple scenario analysis, or you might choose to use the current value method, which we just talked about. Whereas if your company and the performance is, you're still, at a point where you still have several more years, or 3 to 5 more years to go, and there's a lot more ambiguity around, we don't know what the form of our exit will be. We don't know if it makes more sense at this point. We'd get more for a acquisition or a merger relative to an IPO, or we might consider both scenarios. Then you'd be more likely to use like a relative scenario allocation process, or what's called PWORM earlier, or full valuation scenario analysis. So I think the main point of this slide is just to keep to drive home the point that when you're coming up with fair value estimates and you're just trying to decide what methodology to use to allocate fair value across the capital structure, that it's not only the economic rights of the different series of preferred that you consider, but you're also considering your exit strategy and the time from your valuation date to the exit or the liquidity event.
And Michelle, 1 and 3 and the examples there would probably be done under a simple scenario, where 2 might be a relative scenario.
That's right.
Okay. Let's go on to the next slide. The guide itself talks about valuing equity interest in complex structures, which is what we focused on, since most of the items we see out in the marketplace are more in a complex structure. And there's case studies 9, 10, and 11, which would be good to look at in the guide. And then the valuation methodology 1, which is a scenario-based methods, and they focus on the current post-money value or a range of future exit values allocated to the various interests. And these are two of the most relevant valuation methodologies identified by the AICPA guide. Michelle, anything you want to add to that?
What we want to note here is that, the guide scenario-based methods, they address the appropriate methodologies for instances where maybe a post-money assumption of value is considered reasonable. That would be under the simple scenario approach. And then, we want to emphasize that the guide also illustrates the relative value scenario, which we just spoke to earlier, for instances where an investor would attribute differential value to the various classes of equity in the company's capital structure, because there's not enough total value in the company at that point in time at the valuation date to where you would be able to support the assumption that all of the shares of equity in the capital structure would be valued at the same price per share.
All right, next slide. So here we're discussing the simplified scenario. And as Michelle said, it's appropriate if the outcomes for the portfolio company are expected to be bimodal. So basically have immaterial value on the downside, or any liquidation preferences on preferred shares. It's going to be successful, and therefore you exit at a higher price. So something we've talked about and previously and covered that. Next slide, please. Michelle, you want to go through this one?
Sure. I think this, I'm going to apologize because I think this was a little bit repetitive because I kind of touched upon it earlier. I'll quickly go through it. This slide is obviously talking about the current value and waterfall method again. And we wanted to reference this type of total equity allocation methodology and reemphasize that the guide indicates that it's reasonable in certain circumstances, and it differs from the simple and relative scenario analyses method because it assumes that there's going to be a sale of the portfolio company at your valuation date, and it's not forward-looking. Whereas the scenario analyses and those methods of equity allocation, those are forward-looking, to some more so than others. So like the full or the P-worm, a lot of times you'll see that type of analysis and allocation process. It'll assume, sometimes 3 to 5 years in present value that value back to your valuation date. So we just wanted to re-emphasize some of the key differences in these equity allocation methods and re-emphasize when they're appropriate and when they're not. So that's the main point of this slide, which I think we kind of beat to death.
Yeah, I think we forced that into everybody's brain. All right, so next slide, please. So in the last few minutes we have, we're going to kind of talk about COVID-19's impact on valuations. And like everybody else, you probably were reading a bunch of articles towards the end of March. I think the stock market hit its low at March 23rd. So there was a lot of articles the end of March, beginning of April, talking about first quarter marks as compared to December. And, now we're 6 weeks past that. And, the Dow's ahead of where it was at the beginning. I'm sorry, the Nasdaq's ahead of it where it was at the beginning of the year. Not too much of a decline in the other markets. So, it's very volatile. There's a lot of things that are going on, and some companies are actually doing better, and others, travel and leisure, hospitality, those industries are obviously doing worse. So it's not a general, the market's down 30%, so everything should probably go down 30%. You really got to be more industry specific and methodology specific. And we talked about earlier that, fair value is assuming an orderly market, and obviously things that were going on end of March, beginning of April wouldn't be considered an orderly market. You wouldn't and probably didn't see any deals happening around that time. But there are deals that are starting to happen in the private market, as well as M&A transactions, as well as the public market. There was a potential deal announced today where Uber was buying Grubhub. So things seem to have settled down. And, obviously there's some dislocation, and, we talked about being an orderly market, but, you have to kind of weigh all those factors. And Michelle, I don't know if you want to add anything to what's kind of going on currently, and from a valuation perspective, how you would look at it from being a valuation expert.
Sure. One thing is that we included this slide in terms of, how GAAP defines orderly versus disorderly transactions, just as a cautionary indication for the audience to not assume that everything would be priced at a fire sale price at March 31st, if that's one of your reporting dates, or in the, maybe the month subsequent to that. To really prove that a price is reflective of a disorderly market, a GAAP really requires a reporting entity to meet a bunch of different criteria. So we listed them here really quickly. And there wasn't a customary marketing period for the asset that could take place. The seller was at or near bankruptcy, or the seller was required by law to sell the asset to meet a regulatory or other legal requirement. So what GAAP is saying is, okay, those are criteria where we might accept a value indication that is considered disorderly, but in most other cases, you should still assume that a price that was negotiated between a willing buyer and a willing seller and a hypothetical sale, assuming that is what should be considered fair value. And then next slide, please.
And before we do that, let's do our fourth and final secret word, which is capital. CAPITAL, capital, is the fourth and final of the secret words. So to review, attendees, you need all four of these words that we've been reading out to you in the survey we're going to send you. Submit the survey with the words, and you'll get your continuing education credit. And thank you all for your attention to the secret words. And let's go back to our panel now, Tom and Michelle.
Thank you. So really quickly, what we wanted to emphasize about what's fair value in the environment of the pandemic and COVID-19's impact on valuation is just try to highlight what we thought market participants are going to factor into as far as factoring in additional risk and uncertainty into the pricing of investments. And as Tom indicated before, if the market went down 50%, does that mean that I should value all my investments and reduce their value by 50%? I think the answer to that is no. It's not that simple. It's definitely true that market participants are going to factor in this uncertainty into their fair value assessments as it relates to valuation, let's say using a market approach, and entities and funds might question whether or not the decline in fair value for a given investment should be based on that exact same percentage or change in the decline of even the guideline companies that they benchmarked to previously. I think it's important to consider that reporting entities and analysts should consider the implied valuation multiple from the prior reporting date, note, what a premium or discount to the comps, the guideline companies were at that previous date. And then for the updated valuation in this current environment, consider whether or not, that prior premium or discount to the guideline multiple range should be adjusted. And when deciding whether or not it should be adjusted, you should consider, and observe the change in the guideline company multiple range in this current environment, and then determine if your portfolio company, would be more or less sensitive to these recent market conditions compared to your guideline company group. So, for example, you might consider certain internal risk factors of the portfolio company relative to your group of guidelines or your benchmarks. And so when you're looking at your portfolio company and you're trying to decide, is it more or less sensitive, given its level of cash flow generation to changes in the overall market? Is it more or less sensitive given this level of growth relative to, maybe the guideline companies that you were looking at previously? Is it still a lot? Did it grow at all over the last year, or is it still just as small as it was compared to the guideline group last year? What other risks might my company have relative to the guideline group that might warrant either more of a discount than the recent decline that's occurred because of this pandemic, or maybe my company deserves a premium. Maybe my company deserves more of a premium because I have, a much better cash position, or I have a technology or an intangible asset that gives me a competitive advantage that I know is really going to benefit me over the next 6 months to a year because of what happens in the environment. So it's just, again, like many things in valuation, case by case, situation specific for what's going on at your portfolio company, and just taking these broad adjustments based on market indices or a group of market comps that you see is not necessarily what fair value calls for.
Yeah, and to kind of add to that, so if, for instance, one of your valuation methodologies is discounted cash flow, how is this affecting your cash flows? Maybe you're in an industry that's benefiting, so your cash flows are better. And also your discount rate. As soon as this pandemic hit, the Fed dropped the rate to basically zero. So now your risk-free rate dropped down to zero. But obviously there's a lot more risk premium involved because of the volatility of the market. So how does that affect how you calculate your valuations? So, as Michelle said, and like anything in valuation, it's not one simple answer. You really need to look at facts and circumstances of the portfolio companies you have. Next slide. And this last slide talks about some of the things that we kind of just discussed, but, what's the cash runway? Is it able to continue to finance so they continue to have cash to be able to operate? What's that cash burn going to be? How long do they have? So a lot of things you need to look at, different scenario analysis that you may have to look at. Michelle, anything else on this?
No, just to quickly add to what you said, now in this environment, there's probably more of a range of possible outcomes than what you might have thought should be factored into your previous valuation, prior to March 2020. And again, the guide really gives a lot of great examples of different scenario analyses and how to capture risk, as Tom said, maybe in a discount rate, but also through probability weights. So definitely please avail yourselves of the guide case studies, especially if they're really, really helpful.
And that's the end of our presentation. So I didn't know if there was any questions.
Yes, as a matter of fact, first of all, let me say thank you so much to Tom Angell and Michelle Keys for a very fine presentation today. We have just a few minutes left. Let's see how many questions we can get to. I'm going to ask this question, and both of you are invited to weigh in. So here we go. Is there one valuation methodology considered more reliable for estimating fair value in the current environment?
I think it depends on the nature of your investment and what stage of operations, let's say, your portfolio company is in. I don't know, Tom, do you have anything to add to that?
I don't know if there's any one. It falls under the it depends, which is usually always the answer. So
Right.
it's hard to kind of give a concrete, here's the best valuation. It depends on, are we talking venture capital? Are we talking private equity? Where you maybe don't have revenue on a venture fund, but if a portfolio company and a venture fund, but private equity, you've got a history. So there's no one right or wrong method. What I would say is you shouldn't have to switch methods. You should be consistent in your methodology, and just have to adjust it for what the specific aspects of your portfolio company is that you're trying to value.
I would also say that really quickly, if unfortunately you think your portfolio company is really not going to be able to continue to operate as a going concern, and it has a major liquidity problem, you might need to change your valuation methodology to reflect some kind of a orderly liquidation scenario. And obviously that's an extreme case, but that might be that might be the case for certain investments.
Well, panel, we're just about out of time, but we would like to thank our two speakers, Tom Angell and Michelle Keys, before we close, thanking them again for assistance preparing for this event. And for those applying for continuing education credit today, this survey is mandatory. Your state bars and boards require this as a proof of attendance. So you're going to need to enter the secret words we read out earlier. You can also view your certificates, credit requirements, and much more at our website, theknowledgegroup.org, or by downloading the Knowledge Group app available for iOS and Android. And finally, you can follow us across social media. The Knowledge Group can be found on Facebook, Twitter, and Instagram. Be sure to follow us for all the latest news and event information. And by subscribing to our Knowledge Group podcast on iTunes and SoundCloud, hear the very latest on what speakers intend to cover at our events. Now, are you looking for a new way to reach customers and allow them to book and manage appointments with ease? We can help by building you a custom, cost-effective mobile app for iOS and Android. For more information, just send us an email at info@appsforlawfirms.net or visit appsforlawfirms.net. Panel, if you're still on the line, we've got a late question. I want to ask it, so let's try to get it in. So many VC fund managers say they leave it cost for 2 years. Are these auditors that allow this if this is not in keeping with U.S. GAAP? Any thoughts?
Yeah, well, they shouldn't, auditors shouldn't be signing off on that unless the client is documenting why it hasn't had a need to change from its cost basis. But it can't just be a valuation policy that we're just not going to change value for 2 years. They wouldn't be GAAP compliant, so that would be something that wouldn't be allowed.
Michelle, you want to weigh in on that?
I agree with what Tom said from a valuation perspective. Again, what GAAP calls for and what GAAP mandates is fair value, a standard of fair value. And what does that also mandate? As we pointed out in the presentation, you have to assume a hypothetical sale of the investment or transfer of the liability at your valuation date. So it's always important to have the client document, and whether it's just qualitative because there's not enough quantitative information available, what is the rationale or analysis that supports what some market participant or investor would pay for their investment at your current valuation date. That is the minimum, really, of what needs to be done. It's mandatory.
Tom and Michelle, thank you for that response. We thank you for providing that answer. And now, ladies and gentlemen, this concludes today's webcast, Valuation and Accounting for Venture Capital and Private Equity Funds, a practical guide. If you have any other questions for our speakers that we haven't had time for, you can contact them on the details provided within your materials. And if you can't find those for whatever reason, or if you have a question for us, please send an email to info@theknowledgegroup.org.